am Kenny, and today I'll be sharing on question 5 itself. So first of all, let's look at what are the items that are classified under the property, plant and equipment by SIA. Mainly, it would be consisting of the aircrafts, both commercial as well as the training aircrafts, spare engines, flight simulators, as well as the office equipment. Under the notes to financial statement, the section where the significant accounting policies for property, plant and equipment, it is mentioned that the recognition and the measurements of property, plants and equipments are at cost less accumulated depreciation and the accumulated impairment cost, if any. When property, plant and equipment involves a different useful life, SIA will actually account for it as a separate component, and the leasehold properties that is held by the associated companies are measured at fair value, less the accumulated depreciation as well as the impairment loss, if any. Fair value of the leasehold properties under SIA will have an impairment test performed annually by the independent professional valuers. Depreciation of the property, plant and equipment is actually based on the cost of the assets, their operational lives and their residual value, if any, as well as the depreciation methods are reviewed annually and adjusted prospectively. If components of the assets have a different useful life, like I've mentioned, from the remainder of the assets, the component will then be depreciated separately and below. So in general, for the major items, the group would actually depreciate, leaving over a period to a certain residual value on costs. So what constitutes true and fair in SIA's case? We believe that there is actually no definite answer to this question, and it really depends on the business environment as well as the industry itself. The reason why SIA would choose cost over fair value for the major items such as their aircrafts would probably be because of the limited amount of flights that can be done within the day. It is unlike those production industry whereby their property, plant and equipment can be heavily utilized during their start of their machinery lives and lowered nearing the end. That's the explanation I can think of now for the capacity of flights are fixed, so it is not really realistic to measure using a fair value model. Another thing that we can look at is their exclusivity. It is rather complicated and unwise to be using fair value. So in short, what we believe is, as long as the company provides a material information on the financial statement and provides a full disclosure in terms of transparency to help users of financial statements to make economic decisions, it will be deemed as true and fair. Thank you.